Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Tom Gayner, CEO of Markel Group. Tom, great to see you. Thanks for joining us.
Andy, thanks so much for having me. Good to be here.
I know this is a question you often get, but please explain to us what Markel Group is exactly.
Well, Markel Group is an insurance-based holding company. Been around since 1930, so we're coming up on 100 years. We started out in Norfolk, Virginia, insuring jitney transportation devices and taxi cabs of its day, uh, and kept in sort of specialty forms of insurance for a long time. We've been investors in public equity securities for a very long time, and starting about 20 years ago, we moved from buying publicly traded securities to buying wholly owned businesses. So we have a collection of insurance and investment and non-insurance businesses that comprise the Markel Group.
All right. Well, a lot of people might say that sounds a little bit like Berkshire Hathaway. You get that a lot, that you're a little Berkshire Hathaway. Is that the case, Tom? And how intentional is that?
Well, we've certainly studied the playbook and the example of what Buffett built at Berkshire for many, many years. Uh, in 1986, when Markel went public, I was actually an analyst who, lucky enough, was assigned to cover Markel in the IPO process. And I had been familiar through the work of Carol Loomis in Fortune magazine with Buffett from that time. And I saw indeed a specialty insurance focused holding company business that was willing to invest money longer term. And I said to myself right at that point that, boy, that's the formula by which Buffett built Berkshire. So here was an opportunity to see that recreated or that play run right here in Richmond, Virginia, where I was living at the time. So that made all the sense in the world to me. And given the example of how well they've done, it seems a pretty good playbook to follow.
Tom, is it really desirable or even possible to emulate Warren Buffett and the late Charlie Munger and what they've done and did do and are still doing, at least Buffett, in terms of Berkshire Hathaway? How realistic is that?
Yeah, I think in terms of achieving what they've achieved, that is a different issue than emulating how they behave and the way they do things. So, for instance, as a kid, I grew up at the era when John Wooden was the coach at UCLA and was winning national championship after national championship after national championship. And while I was never going to be good enough to play for UCLA, if I was lucky enough to be a basketball coach, I would read everything that Wooden ever wrote, and I would study his videos, and I would observe how he managed to coach that team. And am I going to win 12 national championships if my memory is correct of what he won at UCLA? The answer is probably no. But in terms of the techniques and how you build a team and how you go about things, I think he's an eminently worthy character to study. And oftentimes in the world of sports, you'll hear the phrase coaching tree, whether it's basketball or football, where a coach will be placed in the legacy of he coached under this coach, who coached under that coach. So the ideas involved in the coaching trees and learning from people who frankly are better at it than you'll ever be. Uh, I'd rather learn about something from somebody who's better than I'll ever be than from somebody who's not.
Yeah. Um, so it's a continuous process for you. I know you go to the Berkshire Hathaway annual meeting, Tom. How many have you been to, and what do you do there when you're there?
Well, thank you. It's been 35 years in a row that I've never missed a meeting since I guess the first one that I went to was in 1991. And at that point, what I said to Steve Markel, who was the vice chairman of the company at that point, and my the, my boss who worked for, I said, instead of trying to get people to come to Richmond, Virginia, let's go to Omaha and meet people because the people who are most likely to understand what we're trying to do are people who already own Berkshire. So we went starting in 1991, and I've never missed a year. And the people we've met, the friendships that have been created, the learnings that have happened through that time, the networks that have been built, it's just singular. There's no other place like it.
Yeah, and Markel has a great long-term record for investors. He went public in, 86, 38 years ago, 15% CAGR since then. Medium term, kind of so-so, and then recently you bounced back over the past couple years. Explain that performance, those different phases of the moon, if you will, Tom.
Sure. The 15% is the correct number for since '86, but it's not all been in a straight line. Absolutely not. Different eras, different times, different settings in the financial markets, insurance markets, opportunities, acquisitions that we've done. We're long term people around here, and we're willing to understand that you can't manufacture artificial smoothness. And in fact, again, a lesson you would learn from Buffett. I don't remember the exact numbers he talked about, but it's something along the lines he'd rather have a lumpy 15 than a smooth 10 in terms of percentage returns. And we embrace that idea as well. So the way we've always run this business is try to make good, rational capital allocation decisions, run it to the best of our ability, and do it in a long-term fashion. And again, getting back to the idea of athletics, so many people are involved in the process of sprints. And if you call quarters by quarters by quarters a series of sprints, well, that is a very different race than running a marathon. Now, a marathon will have splits and times within it that if you're a good marathoner, you should be kind of hitting some marks at the 1 mile mark, at the 5 mile mark, at the 10 mile mark. But those are not the final results. And we're marathoners, not sprinters.
As a bit of a long distance runner myself, Tom, I can definitely relate to that analogy. So one thing that's curious to me is the valuation. So first, let me ask you: do you benchmark your returns versus Berkshire and not just the S&P?
No, really, we do the best we can. So, uh, benchmarking is something that everybody is going to do, and you're going to observe and know what that data is. But um, and I can't remember who said this. You should steer by the stars, not by the lights of each passing ship. So I think there is a tendency and a temptation that sometimes we lose track of the stars and where the true North Stars are because we feel we're in a competitive race against some of the other ships. And I think sometimes you can get off track with that and you can lose your focus. It's like driving by looking at the hood ornament of the car rather than the horizon.
Now, you guys have a little bit of a Rodney Dangerfield problem in the market, though, because your trailing 12-month PE is only 14. I should note that Berkshire's is only 12. What is it with you and Warren Buffett? You guys are, hotshot CEOs, but you don't have an NVIDIA PE.
Yeah. Well, and we're not going to. And one of the reasons for that is that the E, and I will confess that I started my life out as a CPA. My professional training is that of an accountant. When you're trying to measure the E of Berkshire or ourselves or companies like us that would have some operational aspects to what goes into creating economic value, as well as some investment returns and some things that are mark to market and some things that are not. Uh, the definition of what the E is oftentimes something that well meaning, talented, thoughtful analysts would have a different opinion about. Now, again, because we are long term owners and we think about long term ownership of the business, I think we, as well as Buffett and Berkshire, do a pretty good job of telling you what the E is, certainly on a normalized basis. And let's say the E, let's double it, stand for economic earnings as opposed to GAAP earnings. When you get that, I think those ratios might be a bit different than what you suggest. And we would be pretty comfortable with the fact that the market over time gets it right with variability and volatility at any sort of shorter point to point kind of estimate. So, for instance, you made the statement at the beginning, you pointed out that the share price has compounded at roughly 15% a year. Our calculation of what we would consider our intrinsic value to be and the way we would track that over the years has pretty much been that exact same number. Um, so the market is efficient over time. It is efficient-ish in shorter time frames, and in any given quarter or even any given year or two, it can be pretty inefficient. But over time, the market gets it right.
I want to ask you about two lines of yours, Tom. I know you're a prolific writer. Again, perhaps a little bit like the mentor in Omaha. Um, one is simple can be harder than complex. That's one of your taglines. Why is that the case? That sounds paradoxical, if not contradictory.
Well, actually, I think that opens up a very interesting topic. and I do tend to spend a lot of time reading. And one of the books I've read twice in the last couple of years is um, General Stanley McChrystal's book, Team of Teams. And I think one of the central themes of that book is talking about the difference between complicated and complexity. So things that are complex, and I heard somebody talking about Einstein the other day. Einstein at some point was talking about his work as being the difference between studying a cloud and a clock. A clock can be very complex. There can be a lot of moving parts in there, and in and of itself, there can be some simplicity that is associated with that clock, in that you can take it apart and you can see the cause and effects that are involved. Things that are complex have what are called wicked feedback loops, where you can do the same thing and it'll have a different outcome the second time you do it than the first time, and you do it the third time, and again, it will have a different sort of outcome. So the ability to kind of keep in mind things that make it complex, make it complicated, and what sorts of wisdom, common sense, rules of thumb, heuristics, whatever you want to call it, to try to keep things as simple as possible so that the human mind can comprehend them, but yet still acknowledge the fact that these are complex systems at play. Um, I just find that kind of mental framing useful to make sure that you don't sort of fall in love with things that are complicated and distill things that are complicated into simple moving parts and think that you've solved the problem because you haven't. It's always nice to be able to uh, maintain an understanding of the difference between things that are complicated and things that are complex. Because I think one of the temptations that one can have is that when you take apart things that are complicated, you might think you've distilled it down to its accurate, simple parts, but you have not really understood the system that's involved. But yet, we're human beings. We need some rules of thumb, some heuristics, some common sense, some wisdom that gives us guideposts to let us know whether we're on the right track or not.
But insurance is complicated, which is a key part of your business, right? I mean, and that's been an advantage. Again, I hate to keep bringing Buffett back up in Berkshire, but it's a similar sort of strategic advantage that it's such a complicated business. You got to have a lot of brain power to be able to navigate your way through it and profit from it, correct?
Well, I would agree with your statement that insurance is a complicated business. The longer I live, the more I appreciate the fact that every business is complicated. Every relationship is complicated. So I think it's a mistake to think you found something that's not complicated. But yeah, I'll put insurance in the complicated bucket along with a lot of other stuff. Now that being said, and the techniques and the tools and the disciplines of insurance are very important and have a lot of technical aspects to them in training. In a conceptual level, insurance is not a complicated business. And one of the ways I would describe it is insurance is a bucket of money. And when you buy an insurance policy and you pay a premium, you are putting money into that bucket. And you and a lot of other policyholders are chucking money into that bucket. If something bad happens to you and you have a claim, then money comes out of that bucket to pay your claim. And so if you look at any insurance company, and this is where investment portfolios within insurance companies come from, is they're managing that bucket of money that they hold. And if that bucket starts overfilling with too much money, that tends to put pressure on insurance prices, and rates tend to go down to sort of uh, make strike some equilibrium as to how much should be there. And if that bucket gets thin, and there's not enough money in it, that oftentimes equates to insurance rates and prices going up just to make sure there's enough money in the bucket to be able to pay the claims appropriately. So yes, it's complicated if you look at it in the details, but if you look at it from the context of the forest versus the trees, there is some underlying simplicity to it.
Got it. Another line of yours, this is front and center on your website. It's kind of the maybe mission statement. And I'm curious why you chose this of all the mission statements in the ether to pick from. We are building one of the world's great companies. Maybe that's axiomatic, but why that?
Well, I think it's a great goal to have. So, for instance, getting back to John Wooden and winning all those national championships, uh, there were a number of years that he spent, call it in the wilderness, before he got to the point where, in fact, he even got to a winning record. but I'm sure he always had the goal in mind to be the very best he could. So, in that notion of building one of the world's great companies, I just think that's something that people can rally around, and it helps you understand what it is we're doing. And one of the things, and it's some wisdom that a friend of mine pointed out to me is that great companies do things for their customers rather than to their customers. So, the first breakdown we would have from building one of the world's great companies is, look, we want to do things across our insurance and non-insurance businesses that do things for our customers. Secondly, we want to do things for each other as colleagues and associates of this business. And we think if we do those two things well, we'll earn good returns on capital from having done so, and we will be operating in a sustainable way where kind of the world wants us to win and wants us to continue to be able to operate because we did something for them that they wanted and needed, and we did it efficiently and at a good enough price that the next time they're faced with a buying decision or referring a customer, they refer people to us. And um, if you look at the long-term record of compounding the value of this business, and that compound effect applies to pretty much every number you could count around here, whether it's number of customers, number of associates, the stock price, whatever, that those have all compounded at good rates for a long period of time. Well, that's because we're doing something that the world seems to want. And so we want to keep doing that.
Tell us about the breakdown of the three business units, I guess, which is insurance, the investment portfolio, and the venture business. How big are each relative to the overall pie, in terms of revenues and profits?
Yeah. So in the course of the last year or so, and again, I'm just trying to keep numbers in my head in rough order of magnitude. The total premium volume of the insurance business, I think, would be roughly $8 billion or so. Our equity portfolio stands at about $12 billion. The total balance sheet stands at about $50 billion. The total revenues of the Markel Ventures set of companies were about $5 billion. In terms of profit contributions, I think it would probably be somewhat close to roughly balanced third, third, third. That's the output, not necessarily the strategic design. We just try to do the best we can in each area of business that we're in. But it does salute the notion that we're somewhat balanced and diversified because there have been years where it's been tough in the insurance business. So it sure is nice to have investment income coming in or Markel Ventures income coming in, or vice versa. Tough here in the investment operations, which happens from time to time. It's nice to have other members of the team, whether they are in insurance or ventures, pulling the oars to make the boat go forward.
Yeah, I read actually in Barron's that the insurance business had lagged a little bit in recent years. Is that the case? And why is that so then?
We've had some challenges in the insurance business, and we've been very candid and frank about that over the last several years. There's some decisions that we made not as well as what we should have, some product lines that we were in that we shouldn't have, uh, and we are responding rationally to those circumstances. We've exited a number of products where we've just found it ourselves unable to run those businesses at a profitable rate. We've made some management changes at very senior levels where unfortunately we had some people who just did not prove to be able to execute as well as what we hoped would be the case. And we've got new leaders in place. So I fully accept the fact that we have indeed underperformed in the realm of insurance. I think we're on track and we made a lot of good decisions. Now, that being said, if we were doing things perfectly today, which we're not, the way insurance works is that there is a tremendous time lag between the decision you make today and how that ultimately appears in your financial statement, sort of as a minimum 2 years. So we're in that process. We're working at it. I think uh, look a couple of years from now, in hindsight, people will be much happier with some of the progress we've made on the insurance side. But we got work to do.
On the investment side, what are some big names, some of your big holdings, and how comfortable are you with them right now, Tom?
Well, if they're big holdings, we're comfortable with them. Otherwise, they wouldn't be big holdings for us. Our largest holding happens to be Berkshire, and that has been the case for quite some time. And again, lots going on at Berkshire these days, but I'm comfortable that that is a supremely well run long term business and has a great future in front of it. We also own big positions in Google and John Deere and Amazon and Apple and Caterpillar Tractor, things of that nature. So high quality businesses that we tend to be able to buy and hold on to for long periods of time.
And you're comfortable with the succession, uh, plan that's going on right now, unfolding at Berkshire Hathaway?
Indeed so, and I think if you look at the history, put in two names I'll cite just from uh, commercial history of the United States over long periods of time. Um, I grew up in the Delaware Valley, and the DuPont company was sort of the towering colossus of that uh, area when I was a kid. Now, the DuPont company is a different thing today than what it was when I was a kid, and there have been some split offs and some reorganizations. But I also went to the University of Virginia, and there are records of dinners out at Monticello in Charlottesville between Thomas Jefferson and Mr. E.I. DuPont himself. So for 200 and some years, that was a company that made good decisions and was run by various people named DuPont and ultimately people not named DuPont. So uh, I would guess if you had to make a list out of memory of people who were successful CEOs of the DuPont company, you couldn't do it. They become names that are not well known in the public sphere in the way that Mr. Guy DuPont himself might have been, that the company was named after. I would also cite ExxonMobil and its predecessors. I think most people know that John D. Rockefeller started that company, but I would guess that most people can't name more than three or four people who have been the CEO of that company for 150 years since John D. Rockefeller was no longer there, but yet it has managed to continue to be a successful business. So Berkshire, obviously, Buffett deserves every bit of credit and acclaim for what he has done, but also part of what he designed and part of what he was doing all the way along was to design Berkshire in such a way that it would be able to persist beyond his personal tenure there. And that's what we're seeing now.
I know you're a bottoms up investor, but do you ever look top down, Tom, and have macro thoughts about the stock market or the economy that impact what you're doing in one of your three business units?
Um, it would be absolutely impossible and frankly irresponsible not to be somewhat thoughtful about what you observe in the macro environment and what's going on in a top-down environment. That said, that tends to be the sort of thing over which you don't have any control. So you're thoughtful, you look at things, you think about some of the pluses and minuses, you think about the risk reward. I mean, it's the fundamental nature of the way we run every single one of our businesses. And it's inherent to the discipline of insurance that you think about the risk you're taking and the reward you're receiving in exchange for that risk. And that's as basic as it gets. But that being said, you then need to make specific decisions which come from the bottom up. And one of the people who I've learned from and studied again, and this goes back 40 or 50 years, and this was a book given to me by my grandmother when I might have been in seventh or eighth grade, but it was by John Train, who was a great financial writer, if you recall him. And one of John Train's comments was, "Investing is the art of the specific." So there is a specific company, a specific idea, a specific price, and you make a decision about that. Uh, so you don't ignore what's going on from the top down, but what you're actually going to do for everybody, even if they're a macro based investor, is what you do from the bottom up in the specific decision.
And final question, Tom, your market capitalization, I think I have this right, is about 25 billion. Berkshire is about 1 trillion. That means they're 40 times bigger. Is that an opportunity for you? Would you aspire to get, build one of the world's greatest companies? You're going to be shooting for that. Part A and part B, are you going to be sticking around many years more to try to accomplish that?
Well, the answer to the second one is yes, to the best of my ability. So I've been here 35 years now and love coming to work here, love being part of this company, and I would like to continue to be able to do that as long as humanly possible. In terms of the question A about those specific numbers, I'm going to go back to we're going to do the very, very best we can. Um, and at the time that Markel went public, I think the market capitalization was $30 million. The time I joined 4 years later, maybe it was roughly $40 million. At this point, it's gone from $40 million to 25 billion. So far, so good. None of those numbers were ever a specific target. They are just what happened along the way as the result of doing the best we could, and that being at a pretty good level. So we'll just try to keep doing that.
Well, I like that. So far, so good. Tom Gayner, CEO of Markel Group. Thank you so much for your time.
Thank you.
This is at Barron's. I'm Andy Serwer. We'll catch you next time.